94% of Germans say no to Tesla. Is Elon Musk losing all of Europe? At the beginning of 2025, Tesla's sales in Germany plunged by 76% in just 2 months. Meanwhile, the entire EV market in Germany grew by over 30%. This was not a slowdown, it was a complete shift. And then an even bigger shock emerged. A nationwide survey showed that 94% of Germans had no interest in buying a Tesla. It wasn't mere consideration, it was outright rejection. Why? What turned a once highly successful electric car brand into a choice that millions of Europeans now refuse to even mention? A crisis of trust has emerged. Tesla isn't just losing market share, it's losing public trust. And in Europe, trust is a matter of survival. Labor disputes, anti-UN policies, Elon Musk's unpredictable leadership style. These aren't just bad news. They're directly influencing consumer decisions. Several major pension funds in Denmark withdrew all investment from Tesla due to ethical reasons. In fact, the ADP pension fund, Denmark's largest with over $160 billion in assets, publicly announced their complete divestment from Tesla, citing concerns about corporate governance and labor practices. Institutional investors managing billions of dollars are pulling out, and when the investment community turns away, so do consumers. The situation raises profound questions about Tesla's future in Europe. Is Tesla still a company of the future, or has it become a financial and ethical risk? The Norwegian Sovereign Wealth Fund, which manages over $1.4 trillion in assets, reduced its Tesla holdings by 60% in early 2025, sending shockwaves through European investment circles. When institutions of this magnitude begin to distance themselves, it signals deeper problems beyond temporary market fluctuations. The Elon Musk factor. For many years, Elon Musk was Tesla's greatest asset, but now he might be its greatest liability. Musk's public support for the AfD party in Germany sparked controversy. In Europe, EVs are not just technology. They represent progress, sustainability, and fairness. When Tesla's CEO sides with divisive politics, buyers pay attention. During a tech conference in Berlin in January 2025, Musk openly praised AfD policies regarding immigration restrictions, causing immediate backlash among German consumers. Sales at Tesla's Berlin showrooms dropped by 82% the following week, according to automotive industry tracker Jato Dynamics. Tesla is no longer just a product. It's also the image of the person behind it. And for many European consumers, that's a reason to say no. A survey conducted by European Consumer Reports found that 68% of potential EV buyers in Germany, France, and the Netherlands cited disagreement with company leadership values as a primary reason for avoiding Tesla. This represents a fundamental shift in consumer behavior. Europeans are increasingly voting with their wallets based on corporate values, not just product features. The situation worsened when Musk attended a rally in Dresden where AfD politicians spoke about rolling back climate regulations. For a company built on environmental credentials, this created cognitive dissonance among Tesla's core European customer base. Former Tesla owners began selling their vehicles, with used Tesla Model 3 listings in Germany increasing by 210% in February 2025, flooding the market and further depressing resale values. Tesla and European labor culture. Another critical issue is Tesla's labor policies in Sweden. The company refused to sign a collective bargaining agreement, resulting in widespread strikes, not just in Sweden but throughout the Nordic region. Unions in Denmark continue to block Tesla deliveries, escalating tensions. In Europe, labor rights are a core cultural value. Tesla's opposition to unions is not just a business decision. It's seen as a disregard for workers' rights. The Swedish Transport Workers Union initiated the strike in October 2024, and by January 2025, it had spread to include dock workers, electricians, and postal workers across Scandinavia. In a particularly damaging development, mechanics at independent repair shops in Sweden refused to service Tesla vehicles, leaving owners stranded with limited maintenance options. The Swedish Metalworkers Union, representing over 300,000 workers, announced a complete boycott of Tesla products among its membership, a devastating blow in a region where union membership often exceeds 70% of the workforce. European consumers are asking, Do they want to support a company that refuses to adapt to local labor standards? The answer, increasingly, is no. When Tesla attempted to open a new service center in Copenhagen in February 2025, local unions organized a protest that drew over 15,000 people, the largest labor demonstration in Denmark since 2008. The Danish government, traditionally business-friendly, publicly criticized Tesla's approach to labor relations, with the Minister of Employment stating that companies operating in Denmark must respect our model of collective bargaining. Conflict with climate policy, a bitter irony. Tesla was built on the foundation of sustainable development, but Elon Musk is now questioning climate policy just as the EU tightens green regulations. The European Union is pushing for stricter emissions laws, while Musk is downplaying the urgency of climate action. Can an EV company survive while opposing the very policies that help them grow? This contradiction doesn't just create confusion, it severely damages Tesla's credibility. In March 2025, during the European Climate Summit in Brussels, Musk tweeted that climate alarmism is doing more harm than climate change itself, directly contradicting the scientific consensus presented at the summit. The EU Commissioner for Climate Action responded by pointing out that Tesla's entire business model depends on the transition away from fossil fuels, a transition Musk now seemed to be questioning. Environmental organizations that once championed Tesla began distancing themselves from the company. Greenpeace Europe announced it would sell its fleet of Tesla vehicles and replace them with EVs from European manufacturers who remain committed to the climate fight. The EU's Carbon Border Adjustment Mechanism, implemented in 2025, places additional taxes on products from companies that don't meet strict environmental standards. While Tesla's vehicles themselves are zero-emission, the company's manufacturing processes in Texas and China came under scrutiny. European automakers quickly adapted their supply chains to comply with the new regulations, while Tesla publicly criticized them as overreaching. This positioning placed Tesla in opposition to Europe's climate leadership, a stunning reversal for a company once seen as the vanguard of sustainable transportation. Hashtag European automakers on the rise. While Tesla struggles, its European competitors are surging ahead. Volkswagen, BMW, Renault, they're not just catching up, they are winning. They don't just sell electric cars, they align with European values, hiring local workers, complying with union laws, and committing to sustainable development alongside the EU. And most importantly, they understand their customers. Volkswagen's ID series saw sales increase by 145% in Germany during the first quarter of 2025, with the ID.4 becoming the best-selling electric vehicle in Europe. The company's Made in Europe, for Europe campaign resonated strongly with consumers, emphasizing local production and European design sensibilities. BMW's i4 and 9 models captured the premium EV market that Tesla once dominated, with sales growing by 112% year-over-year. Even more telling, a consumer satisfaction survey by J.D. Power Europe found that European EV owners reported 28% higher satisfaction with their vehicles compared to Tesla owners, a complete reversal from just 3 years earlier. Renault's affordable Zoe and the new Megane E-Tech became bestsellers in France, Italy, and Spain, markets where Tesla's market share dropped below 5%. The French manufacturer emphasized its commitment to European labor standards in its marketing, a direct contrast to Tesla's ongoing union disputes. Stellantis, the parent company of brands like Peugeot, Citroën, and Fiat, launched 10 new EV models in 2024 alone, covering every price point from budget to luxury, effectively squeezing Tesla out of multiple market segments simultaneously. Tesla still has advanced technology, but technology cannot replace trust. When Mercedes-Benz introduced its EQS sedan with a driving range exceeding that of the Model S, it marked a symbolic shift in the industry. European manufacturers had not only caught up to Tesla's technology, but were beginning to surpass it in certain aspects. The EQS featured materials sourced entirely from suppliers who met the EU's new ethical and environmental standards, another subtle but effective contrast to Tesla's global supply chain issues. Hashtag a fading brand. Beyond politics and policy, something else is happening. Tesla is no longer new. The excitement has gradually faded. For many, Elon Musk's constant media presence has become exhausting. Owning a Tesla used to be a statement. Now it's a question mark. Does this brand still represent the future, or is it being replaced by companies that better understand European consumers? The novelty factor that once drove Tesla's success has diminished significantly. In 2021, seeing a Tesla on European streets would turn heads. By 2025, they had become commonplace, even as their numbers began to decline. The waiting lists that once stretched for months disappeared, with many Tesla showrooms in Europe offering immediate delivery, a sign of weakening demand. Social media sentiment analysis conducted by European marketing firm Mediascope found that positive mentions of Tesla dropped by 76% between January 2023 and January 2025, while negative mentions increased by 340%. Fashion and lifestyle magazines that once featured Tesla as a status symbol began showcasing European electric alternatives instead. Celebrity endorsements dried up, with several high-profile European Tesla owners publicly switching to locally produced EVs. Even in Norway, once Tesla's strongest European market with over 20% market share, Tesla dropped to 6th place among EV brands by early 2025. The Norwegian Electric Vehicle Association's annual member survey revealed that only 7% of current EV owners would consider a Tesla for their next purchase, down from 35% just 2 years earlier. The cultural cachet that Tesla once enjoyed has evaporated with remarkable speed. Tech enthusiasts who once defended Tesla despite its flaws began looking elsewhere as European manufacturers caught up technologically while offering better build quality and customer service. Tesla's direct-to-consumer sales model, once revolutionary, became a liability as European buyers increasingly valued the personalized service and local relationships offered by traditional dealerships during the economic uncertainty of 2024 to 2025. Hashtag what happens next? Tesla is at a crossroads. Governments are watching, investors are skeptical, and consumers are walking away. The question is no longer how much will Tesla grow in Europe, but rather can Tesla even survive? And if this is happening in Germany, Europe's largest car market, then could other regions be next? The stakes couldn't be higher for Tesla's European operations. The Berlin Gigafactory, once hailed as Tesla's bridgehead into Europe, is now operating at just 40% capacity, according to industry analysts. Local German officials who once celebrated Tesla's investment are now concerned about potential layoffs. The factory, designed to produce 500,000 vehicles annually, manufactured fewer than 150,000 in 2024, with projections for 2025 looking even more grim. Financial analysts at Deutsche Bank and BNP Paribas have downgraded Tesla's European outlook, citing structural challenges that go beyond temporary market fluctuations. Morgan Stanley's automotive division published a report titled Tesla's European Exodus. Can the brand recover? Which concluded that regaining European market share would require not just new products, but a fundamental reset of the company's approach to European values and business practices. Tesla's board of directors faces mounting pressure from shareholders to address the European crisis. Some investors have called for regional leadership changes, suggesting that Tesla needs European executives who understand the cultural context and can rebuild trust with consumers and governments. Others have gone further, proposing that Tesla's European operations should be structured as a separate entity with greater autonomy from Musk's direct control, a suggestion that has reportedly been met with resistance from Tesla headquarters. The European Commission has launched an investigation into Tesla's labor practices, potentially leading to significant fines or restrictions. Meanwhile, European automotive manufacturers are accelerating their EV development programs, sensing an opportunity to permanently reclaim their home markets from what was once their most formidable competitor. Don't look away. The biggest changes are still to come. Hashtag is the U.S. supply chain collapsing? China's latest move is driving prices skyrocketing. 20%. That's the shocking drop in U.S. imports from China just last year. What does this mean? Will prices continue to soar? Could essential goods disappear from shelves? The truth is America's supply chain is in serious crisis as China cuts exports and reduces its holdings of U.S. bonds. Let's dive in and uncover how this move is reshaping the global economy forever. Hashtag China cuts investment in the U.S. What's happening? Here's the reality. The U.S. has been too dependent on China for decades. America benefited from low-cost imports from China, but now that economic order is collapsing as Beijing dramatically reduces its holdings of U.S. Treasury bonds. In January 2025, China announced a reduction of $200 billion in U.S. Treasury holdings over the next 18 months, representing nearly 30% of their total investment. This wasn't just a financial decision, but a strategic one, coming after increased tensions over technology restrictions and trade policies. Why does this matter? Because Treasury bonds are a key source of funding for the U.S. government. If China cuts its investment, the U.S. will have to raise interest rates, borrow more, and face the risk of severe inflation. The Federal Reserve estimates that for every $100 billion reduction in foreign Treasury holdings, U.S. interest rates could rise by 0.15 to 0.2 percentage points. With China's planned $200 billion reduction, this could translate to a 0.3 to 0.4 percentage point increase in borrowing costs across the economy, affecting everything from mortgages to business loans. But that's not all. China is also tightening its grip on exports of critical materials, a move that could cripple key U.S. industries. In February 2025, China implemented new export controls on 17 rare earth elements essential for electronics, renewable energy, and defense applications. These restrictions limit exports to 70% of 2023 levels, creating immediate shortages in global supply chains. When China restricted rare earth exports to Japan in 2010, prices increased by over 600% within months. Analysts expect similar or worse effects from these new, broader restrictions. Hashtag is the global supply chain collapsing? Let's look at some industries hit the hardest. Technology and electronics. Over 70% of consumer electronics in the U.S. come from China. If supply is cut, prices will skyrocket. Would you pay double for an iPhone? The semiconductor industry, already struggling with shortages since 2021, faces new challenges as China restricts exports of gallium and germanium, critical materials for chip production. Apple has already warned shareholders that production constraints could reduce iPhone availability by 30 to 40% in the coming quarters. Dell and HP have increased their computer prices by 12 to 18% in anticipation of supply chain disruptions. Automotive industry. Essential materials for EV batteries and auto components mostly come from China. If Beijing limits exports, the U.S. could face an electric vehicle supply crisis. Tesla has delayed the launch of its new affordable model by 18 months due to battery material constraints. General Motors reported that their EV production targets for 2025 may be reduced by 200,000 units due to material shortages. The average price of lithium-ion batteries increased by 25% in the first quarter of 2025, reversing years of declining costs that had made EVs increasingly competitive with gasoline vehicles. Renewable energy. China controls over 90% of rare earth production, key for solar panels, wind turbines, and lithium batteries. If China restricts supply, America may fall behind in the clean energy race. The American Clean Power Association estimates that solar panel prices have already increased by 35% since China's export restrictions began, threatening the viability of numerous renewable energy projects. Wind turbine manufacturers report that specialized magnets containing neodymium, a rare earth element primarily produced in China, have become difficult to source at any price, potentially delaying installation of 5 to 7 gigawatts of wind power capacity in 2025 alone. And here's the real problem. U.S. companies can't quickly find alternative suppliers. Why? Because manufacturing costs in the U.S. are significantly higher than in China. Establishing new production facilities for critical materials can take 5 to 10 years and billions in investment. The Boston Consulting Group estimates that reshoring production of critical electronic components to the U.S. would increase manufacturing costs by 25 to 40%, costs that would ultimately be passed to consumers. The result? Consumers will pay the price. A study from the Peterson Institute for International Economics found that if this trend continues, the average American household could pay an additional $22,000 per year for goods and services. This isn't just inflation, it's a fundamental restructuring of what Americans can afford. The study breaks down this impact across categories. For $1,800 in increased costs for electronics and appliances, $6,200 for automotive purchases and transportation, $5,500 for housing and construction materials, and $5,500 for general consumer goods. Hashtag is the US dollar losing its power? It's not just the supply chain. The US dollar's dominance is also at risk. Consider this. China is increasing trade settlements in yuan, RMB, with major partners like Russia, Brazil, and India. In 2023, only 2.7% of global trade was settled in yuan. By early 2025, that figure had jumped to 7.3%, representing the fastest growth of any currency in international trade. China and Brazil signed an agreement to conduct all bilateral trade in their own currencies, bypassing the dollar entirely. A significant development given that Brazil is China's largest trading partner in Latin America with annual trade exceeding $150 billion. BRICS nations have begun reducing their reliance on the US dollar in global trade. At the 2024 BRICS summit in Kazan, Russia, member countries announced the creation of a new payment system independent of SWIFT, allowing them to conduct international transactions without using the dollar. India and Russia have already moved 65% of their bilateral trade to this new system, with other BRICS members following suit. The share of US dollar reserves worldwide has dropped from 71% in 1999 to just 58% in 2023, and preliminary data suggests this declined further to 55% by early 2025. The International Monetary Fund reports that central banks globally are diversifying their reserves away from the dollar at the fastest rate in decades, with gold, euro, and yuan being the primary beneficiaries. Saudi Arabia, historically a stalwart supporter of the petrodollar system, began accepting yuan for 25% of its oil sales to China in 2024, a symbolic blow to dollar dominance in energy markets. If this trend continues, the U.S. could lose one of its biggest economic advantages, its ability to control global financial policies through the dollar. The consequences would be far-reaching: higher borrowing costs for the U.S. government, reduced purchasing power for American consumers, and diminished influence in global economic governance. The Congressional Budget Office estimates that a 10% reduction in foreign demand for U.S. Treasury securities could increase federal interest costs by $75 to $100 billion annually, adding to an already troubling deficit situation. A major question arises: is this the beginning of the end for U.S. dollar dominance? Hashtag can the U.S. respond to this crisis? The U.S. cannot afford to sit back, but the question is, what can it do to fight back? Some measures have been proposed. The CHIPS Act, a $52 billion investment to boost domestic semiconductor production. But is it enough? Experts estimate that it could take over a decade to build a self-sufficient supply chain. While the legislation represents an important first step, industry analysts point out that $52 billion pales in comparison to China's $150 billion semiconductor initiative announced in 2021. Taiwan's TSMC alone is investing $40 billion in advanced chip manufacturing, highlighting the scale of investment required to achieve meaningful independence in this critical sector. Encouraging companies to relocate supply chains to friendlier nations like India and Mexico, but production costs will be significantly higher. The Mexico Nearshoring Initiative, launched in late 2024, offers tax incentives for U.S. companies relocating production from China, but early participants report 15 to 20% higher operational costs compared to their Chinese facilities. Labor productivity differences, infrastructure limitations, and smaller economies of scale all contribute to these higher costs, which ultimately reach consumers through higher prices. Increasing tariffs on Chinese goods, but this will only make prices rise even further for American consumers. The Congressional Budget Office analyzed the impact of proposed additional tariffs on Chinese imports and concluded they would increase consumer prices by 1.5 to 2.2% across affected categories, while reducing GDP growth by 0.3 to 0.5% due to reduced consumer spending power. Previous rounds of tariffs have shown that approximately 85% of their cost is passed directly to American consumers rather than being absorbed by Chinese exporters. So what's the real solution? Can the U.S. quickly reduce its reliance on China, or is it already too late to change the game? The Strategic Materials Security Act, currently being debated in Congress, would establish a $75 billion fund to develop domestic production of critical materials. But even its supporters acknowledge it would take 5 to 7 years to significantly impact supply chains. Meanwhile, the Department of Defense has begun stockpiling critical materials, but current reserves would only meet military needs for 6 to 8 months in case of a complete supply disruption. The decisions made today will determine the future of the global economy. What do you think? Can the U.S. turn this around? Stay tuned for the next developments. #Canada challenges the U.S. Could these bold moves change the game? 250% tariff on Canadian dairy, 50% tariff on steel and aluminum, and a $100 million contract with Starlink canceled. When Donald Trump imposed these huge tariffs on Canada, how will the country respond? Will they endure or stand up strongly to change the trade dynamics? #Trump's extremely harsh measures. When Donald Trump decided to impose tariffs on Canada, he didn't just stop at ordinary tariffs. He introduced massive figures such as 250% tariffs on Canadian dairy products and 50% on steel and aluminum, aiming to increase pressure on Canada's key industries. These tariffs were unprecedented in modern U.S.-Canada relations, affecting over $35 billion in trade annually. The dairy tariff particularly targeted Quebec's dairy industry, which employs over 83,000 people and contributes $6.2 billion to Canada's GDP. The steel and aluminum tariffs impacted Ontario's manufacturing heartland, threatening 40,000 direct jobs and over 100,000 indirect positions in related industries. These moves sent Canada's economy into turmoil. The Canadian dollar immediately dropped 3.2% against the US dollar following the announcement, while the Toronto Stock Exchange saw its worst single-day decline in 3 years, with the S&P/TSX Composite Index falling 4.7%. Economic forecasters at the Royal Bank of Canada revised their growth projections for the Canadian economy downward by 0.8 percentage points, warning of a potential recession if the tariffs remained in place long-term. What impact do these actions have on both the U.S. and Canada? Yes, with these tariffs, not only Canadian goods are affected, but U.S. manufacturers and consumers will also be impacted as prices rise. The Peterson Institute for International Economics estimated that American consumers would pay an additional $5.6 billion annually for goods affected by these tariffs. U.S. manufacturers who rely on Canadian steel and aluminum reported average cost increases of 17 to 22%, forcing them to either absorb these costs or pass them on to consumers. The American dairy industry, while initially supportive of protections against Canadian competition, began expressing concerns about potential retaliatory measures that could close export markets. However, can Canada just sit back and endure? The answer is no. These tariffs truly created a crisis in trade relations between the two nations. Major industries in Canada, from steel production to agriculture, are severely affected. The Business Council of Canada estimated total economic damage at $12 billion annually if the tariffs remained in place, equivalent to approximately 0.6% of Canada's GDP. Small businesses were particularly vulnerable, with a survey by the Canadian Federation of Independent Business finding that 62% of affected small business owners feared they might have to close operations within 12 to 18 months if the tariffs continued. But what happens if these tariffs not only harm Canada, but also create a wave of opposition from U.S. consumers and businesses? Ontario's aggressive response, cutting power supplies to the U.S. Immediately after these tariffs were announced, Doug Ford, the Premier of Ontario, responded very aggressively. He declared that Ontario would not hesitate to cut off power supplies to the U.S. if tensions continued. This is not an empty threat. Ontario provides about 25% of the energy to U.S. states, particularly in the Northeast. The province exports approximately 24 terawatt-hours of electricity annually to New York, Michigan, and other border states, enough to power 2.5 million American homes. During peak demand periods, particularly in summer and winter extremes, several U.S. regions depend heavily on this Canadian power to prevent brownouts and maintain grid stability. If the province decides to cut off the energy supply, thousands of U.S. businesses and households will face immediate difficulties. Energy analysts at S&P Global estimated that an Ontario power cutoff could increase electricity prices in affected U.S. regions by 30 to 45% almost overnight, potentially triggering rolling blackouts during periods of high demand. Critical infrastructure, including hospitals, data centers, and manufacturing facilities, would need to activate emergency power systems, many of which are designed only for temporary operation. This is a powerful economic move that Canada can use to put pressure on the U.S. If Canada follows through with this action, the impact will not be limited to trade. It will extend to the energy sector, threatening to disrupt the daily lives of millions of Americans. The North American Electric Reliability Corporation warned that northeastern U.S. states would face a 15 to 20% electricity deficit without Canadian imports, requiring emergency conservation measures and possible controlled outages during peak demand periods. And the question is, can the U.S. endure when such a crucial part of its energy supply is cut off? The Department of Energy conducted an emergency assessment that concluded it would take 18 to 24 months to replace the lost Canadian electricity through new domestic generation capacity. In the meantime, economic damage could reach $50 to $70 billion, primarily affecting manufacturing, healthcare, and technology sectors in border states. Political pressure would be intense, with governors from affected states already lobbying Washington for a resolution to the trade dispute before any energy disruption occurs. Hashtag Ontario cancels $100 million contract with Starlink. But Ontario didn't stop at just threatening to cut power. They decided to cancel a $100 million contract with Starlink, Elon Musk's satellite company. This contract was initially signed to provide satellite internet to remote areas of Ontario, covering approximately 250,000 households in rural communities that lack reliable broadband access. The 5-year agreement represented one of Starlink's largest government contracts worldwide and was seen as a showcase project for the company's rural connectivity capabilities. This decision clearly shows that Canada is not afraid to take away economic cooperation opportunities if necessary to protect its national interests. Ford didn't hesitate to criticize Musk for aligning with Trump's policies. During a press conference announcing the cancellation, Ford stated, "We cannot continue to do business with companies whose leadership actively supports policies that harm Canadian workers and families." The Premier noted that the province would redirect the funds to Canadian telecommunications providers who could offer similar services, potentially at higher costs, but keeping the economic benefits within Canada. It's ironic that Elon Musk, someone who once studied in Canada, would now take a stance against the very country that helped him. Musk attended Queen's University in Kingston, Ontario, for 2 years before transferring to the University of Pennsylvania. This further underscores that Ontario isn't just challenging trade policies, but also bringing economic partnerships into the equation. The province's Minister of Economic Development emphasized this point, saying, "Mr. Musk benefited from Canadian education and early career opportunities, yet now supports policies that would devastate Canadian industries. We must respond accordingly." When Musk, who once studied in Canada, chooses to align with a policy that harms the very country that helped him, Ontario is not just canceling a contract, but sending a strong message. We are not afraid to sacrifice economic benefits if it protects our country. The cancellation immediately impacted Starlink's expansion plans in Canada, with the company putting on hold a planned $220 million investment in ground station infrastructure that would have created approximately 300 technical jobs. Analysts at Morgan Stanley estimated that the lost contract and subsequent expansion delays would reduce Starlink's projected revenue by $380 to $420 million over 5 years. And the question is, will Musk face consequences from this decision? Beyond the immediate financial impact, the Ontario government's actions sparked similar reviews of Starlink contracts in British Columbia and Quebec, potentially threatening an additional $175 million in government business. Technology industry observers noted that the public nature of the dispute could influence other international customers considering large government contracts with the company, particularly in countries with close ties to Canada such as Australia and the United Kingdom. Hashtag using key minerals to apply pressure. Canada isn't just using tariffs or canceling contracts to fight back. They also hold a very powerful weapon, minerals. One of the key resources Canada can use to put pressure on the U.S. is nickel, a vital material for the U.S. automotive and technology industries. Canada supplies nearly half of the nickel that the U.S. needs, approximately 180,000 metric tons annually valued at over $3 billion. This Canadian nickel is particularly critical for electric vehicle battery production, with each EV requiring 40 to 80 pounds of the metal. As the U.S. pushes to expand its electric vehicle manufacturing, this dependency has become increasingly strategic. If Canada decides to limit the export of this resource, it would pose a significant challenge to the U.S. industrial sector. The U.S. Geological Survey classifies nickel as a critical mineral with high supply risk, noting that domestic production meets less than 1% of U.S. demand. Beyond nickel, Canada is also a crucial supplier of aluminum, providing 50% of U.S. imports, uranium, 36% of U.S. imports, and potash, 83% of U.S. agricultural fertilizer imports. Each of these materials has limited alternative sources that could be quickly developed. Can the U.S. cope without nickel from Canada to support its industries? Industry experts suggest it would take 7 to 10 years and billions in investment to develop alternative nickel supplies. The benchmark Mineral Intelligence Consultancy estimates that without Canadian nickel, U.S. EV production targets would need to be reduced by 30 to 40% through 2030, severely impacting climate goals and industrial competitiveness. Tesla's chief procurement officer privately acknowledged to shareholders that a disruption in Canadian nickel supplies would force production cuts within 60 to 90 days as inventory buffers were depleted. Ford has emphasized that Ontario can use minerals as a strategic tool to affect the U.S. economy. In a speech to the Ontario Mining Association, he stated, "Our resources are not just commodities. They are strategic assets that give us leverage in international relations." The Premier directed provincial agencies to prepare contingency plans for implementing export controls on critical minerals if the trade dispute escalated further. Mining companies in Ontario reported being approached by provincial officials to discuss how export restrictions might be implemented while minimizing impact on Canadian operations. Tightening the export of these important resources will disrupt U.S. companies, forcing America to return to the negotiating table to resolve the trade conflict. This is not just a tariff battle, but a war over strategic resources. The U.S. Department of Commerce has already established an emergency task force to assess vulnerabilities and develop contingency plans should Canada restrict mineral exports. Initial assessments suggest that even short-term restrictions could create supply shocks that would ripple through multiple industries, from automotive to aerospace to defense. Don't take your eyes off this, as many exciting developments are waiting for you. The U.S. has just imposed a 50% tariff on Canadian goods with a shocking condition for removal. Canada must become the 51st state. This unprecedented policy has sparked outrage across economic, political, and business circles. A top economist has taken to the airwaves to slam the move, questioning whether it is a strategic play or a catastrophic gamble. On March 10, 2025, the U.S. administration announced a 50% tariff on all Canadian imports. While America has used tariffs as a trade weapon before, this is the first time such an extreme condition has been tied to a tariff rollback. Canada must become part of the U.S. The U.S. and Canada are deeply intertwined economic partners. Total trade between the two nations hits $793 billion in 2023. Canada is America's top trade partner, making up 14% of U.S. global trade. 75% of Canada's exports flow directly to the U.S., making it highly dependent on American markets. The new tariffs would affect approximately $397 billion worth of Canadian goods entering the U.S. annually, an unprecedented economic action against a close ally. Canadian industries most severely impacted include automotive manufacturing, $62 billion in exports to the U.S., energy products, $115 billion, and forest products, $45 billion. If the 50% tariff holds, both economies will face serious damage. The oil and gas industry would be particularly hard hit. Canada provides 50% of U.S. crude oil imports, approximately 4.3 million barrels per day. A tariff hike could skyrocket oil prices, raising manufacturing and transportation costs throughout the American economy. Energy economists at Goldman Sachs projected that sustained tariffs would increase U.S. gasoline prices by $75 to $1.10 per gallon within 60 days, creating immediate inflationary pressure across all sectors of the economy. The aluminum and lumber industries would also face severe disruption. Canada supplies 59% of U.S. aluminum imports, critical for everything from beverage cans to aircraft manufacturing, and 26% of construction lumber. Expect higher costs for cars, homes, and consumer goods. The National Association of Home Builders estimated that the tariffs would add $18,000 to $25,000 to the cost of an average new home in the U.S., further exacerbating the housing affordability crisis. Automotive manufacturers warned that vehicle prices would increase by $2,500 to $4,500 per unit, potentially reducing annual sales by 1.2 to 1.8 million vehicles. Inflation experts predict this policy could drive U.S. inflation up 1.8% within 6 months, worsening America's ongoing economic struggles. The Federal Reserve Bank of Boston released an analysis suggesting that the tariffs would necessitate additional interest rate hikes to control inflation, potentially triggering a recession with unemployment rising by 1.2 to 1.5 percentage points. Small businesses would be particularly vulnerable, with the U.S. Chamber of Commerce estimating that 380,000 to 450,000 small business jobs could be lost due to higher input costs and reduced consumer spending. Stay tuned. Expert reactions and business fallout are just beginning to unfold. Immediately after the announcement, CNBC's chief economist Steve Lehman blasted the policy on live TV. He called it insanity, arguing that the U.S. lacks a clear strategy and is instead destroying market confidence while harming its own economy. This isn't just bad economics. It's economic self-harm on an unprecedented scale, Lehman stated during primetime coverage. We're witnessing the weaponization of trade policy for political theater at the expense of millions of American consumers and workers. The financial markets plunged in response. S&P 500 fell 2.1% in just 24 hours. The Canadian dollar lost 4.3% of its value, increasing import costs for Canadians. Stocks of FedEx, General Motors, and Boeing dropped between 3% to 5%. Signaling concerns in supply chains and global commerce. Trading was temporarily halted on several major Canadian companies listed on U.S. exchanges as sell orders overwhelmed the system. The Chicago Board Options Exchange Volatility Index, VIX, often called the Fear Index, jumped 45%, its largest single-day increase since the 2020 pandemic market crash.